Welcome to the deep dive. Okay, let's talk about something fundamental in finance, a challenge really baked into any system with lending. What happens when loans go bad? When they just don't get paid back? It's a massive issue. It affects everything from that small business down the street needing capital right up to the overall health of the entire national economy. Loans are, well, they're the engine oil for growth, right? But sometimes things go wrong and these loans turn into what the jargon calls non-performing assets or NPAs. And when these NPAs start piling up, the impact can be pretty severe. It can really gum up the works, slowing down new credit, hindering economic growth.
Yeah, and it can even become a risk to the banks themselves, to the financial institutions. It shakes stability.
Exactly. So today we're doing a deep dive into how India specifically has built up a pretty sophisticated toolkit to tackle this exact problem. We're going to unpack the Sarfazi Act, look at these things called asset reconstruction companies, ARCs, and then get into the big one, the Insolvency and Bankruptcy Code, or IBC.
Yeah, and what's fascinating here, I think, is that these aren't just separate tools lying around. They're designed to work together like interconnected gears in a larger strategy for dealing with financial distress. And for you listening, maybe especially if you're preparing for something demanding like the RBI Grade B exam, really getting these isn't just about memorizing facts.
Right.
It's about understanding how they actually work in practice, how they interact, their real impact. That's the deeper level you need.
So what's the plan for today?
Okay, so we'll start with the specialized players, the ARCs. Then we'll tackle the big comprehensive framework, the IBC. We'll also touch upon the foundational Sarfazi Act, which kind of enables a lot of this. And then, crucially, we'll bring them all together, do a sort of side-by-side comparison so you can see clearly how they fit their different jobs. Our mission really is to give you that shortcut to being properly informed, hopefully trigger a few aha moments, and get you the essentials without, drowning you in jargon.
Okay, sounds good. Let's kick things off by defining the problem itself, non-performing assets. So at its most basic level, what is an NPA? It's essentially a loan where the payment, either the principal or the interest, hasn't been made for more than 90 days. Simple as that, right? It's like the loan's health status just flipped from active to uh-oh.
Uh-oh is a good way to put it.
Yeah.
But it's not just one big bucket labeled bad. The RBI and the whole system really breaks it down further based on how long it's been bad and, well, the chances of getting the money back.
Right, so there are categories.
Exactly. First, you've got what's called a substandard asset. This is when the loan has been an NPA, so overdue for 90 days, but for less than a full year, less than 12 months. It means there are problems, definite weaknesses, but, there's still a reasonable expectation of recovery, at least partially.
Okay, so stage one, essentially. What's next?
If that default drags on for more than 12 months, it gets upgraded or maybe downgraded to a doubtful asset.
Doubtful? Sounds, well, doubtful.
Precisely. At this point, the chances of recovering the full amount are significantly lower. There's major uncertainty. The collateral might not cover it. The borrower's situation looks worse. It's a more serious category.
Got it. And the worst case?
That's the loss asset. This is where the bank or the regulator basically considers the loan uncollectible. There's virtually no hope of recovery. It might still technically be on the books for a bit, but it's essentially written off or needs to be fully provided for. It's considered lost value.
And historically, trying to get money back from any of these, especially doubtful or lost assets, through the old legal routes in India, that was tough, wasn't it?
Well, incredibly tough. Slow, cumbersome, very expensive. It could take years, decades sometimes, winding through the courts. And that's a huge drag on the banks, which really highlights why new approaches were desperately needed.
Which brings us neatly to the first of those new approaches, asset reconstruction companies, the ARCs.
Exactly. That slow, traditional recovery process, it just wasn't working effectively. You have to remember, a bank's main job is lending, right? Assessing credit risk, providing loans. They're not typically set up to manage deeply distressed companies or fight prolonged legal battles over collateral. That's not their core expertise.
So ARCs step into that gap.
Precisely. They are specialized financial companies. Their entire purpose is to buy these non-performing assets from banks and other financial institutions. They take the problem loans off the bank's hands.
And they get called bad banks, which sounds a bit odd.
It does, but it actually describes their function perfectly. They act like a filter, absorbing the bad loans, the NPAs, from the regular banks. This cleans up the original bank's balance sheet, frees up capital that was stuck in non-earning assets, and allows the bank to focus back on its main business, lending and supporting the economy.
So where did this idea come from? How did these bad banks get started in India? You mentioned the Sarfazi Act, 2002. That seems key.
Absolutely foundational. So RRC provides the legal framework, the actual power, for RRCs to exist and operate in India. It was a huge shift. But the idea wasn't pulled out of thin air. It actually came from recommendations made by some very important committees looking into banking sector reforms back in the day.
Ah, like the Narasimham committees.
Exactly. The Narasimham Committee of and 2 and also the Anti-Arjuna Committee. They all identified this NPA problem and suggested creating specialized vehicles, like ARCs, to deal with it effectively.
So following those recommendations.
The first RRC in India was set up. That was ARCIL, the Asset Reconstruction Company, India Limited, established right back in 2002, the same year Sarfazi came into force.
Okay, so ARCIL was the pioneer, and more recently.
More recently, yes, there's been a big government-backed initiative. In 2021, NRCL was established the National Asset Reconstruction Company Limited.
NRCL, what's its specific focus?
NRCL is designed to tackle the really large NPAs, specifically those stress loans above 500 crore. It's a targeted effort to resolve some of the biggest bad debt problems weighing down the system.
Okay, so these ARCs play a critical role. Who keeps an eye on them? Who regulates the bad banks?
Right, good question. While they get their registration under the Sarfazi Act, the primary regulator watching over their operations is the Reserve Bank of India, RBI. The RBI lays down detailed rules in its master directions, which were actually updated fairly recently in 2024. These cover everything from capital requirements to governance.
And you mentioned capital requirements. Have those changed?
They have, and quite significantly. It shows the RBI is really tightening the screws, ensuring these entities are robust. They need to maintain a minimum net owned fund, or NOF. Back in October 2022, the minimum NOF was 100 crore. By March 2024, it had doubled to 200 crore.
Doubled. Wow.
Yeah, and looking ahead, the requirement is set to increase again. By March 2026, ARCs will need a minimum NOF of 300 crore.
So a threefold increase in just a few years, that's a clear signal.
Definitely. It ensures they have enough skin in the game, enough capital buffer to handle potentially large losses from the assets they acquire. There are also rules about getting started. Once an ARC gets its registration certificate from the RBI, it has to actually start its business operations within 6 months.
6 months? That's pretty quick.
It is, though the RBI can grant a one-time extension up to a maximum of 12 months in total, but the pressure is on them to become active players in resolution quickly.
Okay, so they're well capitalized, regulated, but how do they actually make money? How does an ARC take a bad loan and turn it into something, well, less bad or even profitable? Let's unpack the business model.
Right, let's walk through it. Generally follows a few key steps. Step 1 is asset acquisition. This is where the ARC identifies NPAs on the books of banks or financial institutions and negotiates to buy them.
They just pick any bad loan.
Not quite. They do their homework first. There's a mandatory minimum period of 2 weeks just for due diligence. They'll scrutinize the loan documents, assess the value and condition of any collateral, look into the borrower's business, estimate the likely recovery amount. It's quite detailed.
And are there rules about which assets they can buy?
Yes, crucially. To avoid conflicts of interest, an ARC is prohibited from buying assets from its own sponsor bank or a financial institution.
Ah, okay.
Nor can it buy from the bank that originally lent the money or from any entity within its own corporate group. The transaction has to be at arm's length.
Makes sense. So they buy the asset. What's next?
Step 2 involves issuing security receipts, or SRs. Think of SRs as financial instruments like bonds or notes that the ARC issues. They issue these SRs to what are called qualified buyers, QBs. These QBs could be the selling bank itself, wanting to retain some potential upside, or other institutional investors like mutual funds, insurance companies, even other ARCs sometimes.
And these SRs represent?
They represent a claim, basically an ownership interest, in the recoveries that the ARC eventually makes from the underlying stressed asset it bought. The value of the SR depends entirely on how successful the ARC is in recovering money.
Does the ARC itself have to invest?
Yes, absolutely. This is the skin in the game requirement we talked about. The ARC must mandatorily invest in the SRs and issues. The minimum amount is the higher of two calculations, either 15% of the selling bank's investment in those SRs or are 2.5% of the total value of all SRs issued for that asset.
Okay, so they're aligned with the other investors.
Exactly. Their money is on the line too. Now, within 6 months of issuing the SRs, a credit rating agency has to assign a recovery rating, or RDA them. This helps the QBs understand the risk involved. And the ARC has to calculate the net asset value, NAV, of these SRs. This is typically the estimated recovery value divided by the original loan's face value. And this NAV needs to be updated regularly, twice a year, June 30th and December 31st, to reflect how the recovery is progressing.
Right, so acquisition, issuing SRs, then comes the actual work.
Right.
Recovery.
Precisely. Step 3 is recovery strategies. And this is where ARCs get creative. They typically have a maximum time frame, usually 8 years, to resolve the asset and recover the money. And their toolkit is pretty diverse. They don't just sue people. They can, for instance, take over the management of the defaulting company, maybe bring in new leadership.
They can run the company?
In some cases, yes, or at least heavily influence it. They can also sell or lease the entire business, or specific assets, maybe a factory, some land. They might reschedule the debt, working out a new, more manageable repayment plan with the borrower if they think the business is fundamentally viable.
Okay.
They can, of course, enforce the security interest that's using the power under Sarfeesi to take possession of and sell the collateral. They can also negotiate settlements directly with the borrowers or promoters. Or in some situations, they might even do an equity swap, converting some of the debt they hold into ownership shares in the company. This gives them a direct stake in turning the company around. It's a multi-pronged approach.
That's a pretty broad set of tools. So connecting this back, why are these ARCs so important for the bigger picture, for the financial system?
Their impact is quite significant, really. Let's tick off the main advantages. First and foremost, as we said, they clean up bank balance sheets. Getting those MPAs off the books makes banks look healthier, reduces their provisioning needs, frees up capital.
Which should mean they can lend more, right?
Exactly. That's the second big advantage. Reviving credit flow. Healthier banks are more confident and capable of lending, which is absolutely crucial for economic activity. Third, ARCs often focus on rehabilitating sick companies. Their expertise isn't just in recovery, but often in restructuring and turning businesses around. This can save jobs, keep production going, which has wider economic benefits.
Rather than just liquidating everything.
Often, yes. Liquidation might be the last resort. And fourth, they attract private capital and expertise into the stressed asset market. Resolving complex bad loans requires specialized skills and funding, and ARCs bring that to the table.
Okay, those are strong positives, but are there downsides? Risks involved?
Oh, definitely. No system is perfect. One major concern economists often raise is moral hazard.
Moral hazard, meaning?
Meaning, if banks know they can easily sell off their bad loans to an ARC, especially a government-backed one like NRCL, will they become less careful in their lending decisions in the first place?
The safety net problem. They might get lazy with due diligence.
Potentially, yes. Knowing there's a buyer for their mistakes might reduce the incentive for prudent lending. That's something regulators have to watch very carefully. Another risk, particularly with government-backed ARCs, is the potential burden on taxpayers. If the ARC pays too much for the assets, or is inefficient in recovery and ultimately makes losses, guess who might end up footing the bill?
The public purse?
Could be. So efficiency, transparency, and realistic pricing are critical to avoid that. These risks mean regulation is absolutely key.
Which brings us back to the RBI's oversight. You mentioned capital adequacy, but what other specific rules keep ARCs in check?
Right, beyond just the initial registration and NOF, the RBI has quite a detailed rule book. We mentioned capital adequacy. Like banks, ARCs must maintain a minimum capital to risk-weighted assets ratio, CAR, of 15%. This acts as a buffer against losses.
15%, okay.
Then there's asset classification. For ARCs, it's slightly different than for banks. An asset they hold is considered standard if payments are coming in on time according to the restructured plan. But if a payment becomes overdue by 180 days or more, it gets classified as an NPA on the ARC's books.
180 days, not 90 like banks.
Correct. It's a longer time frame, 180 days for ARCs, reflecting their specific business model, which often involves longer restructuring periods. They also have specific provisioning rules. They have to set aside money to cover expected losses. For substandard assets on their books, it's a 10% provision. For doubtful assets, it gets higher. 100% provision for the unsecured part of the loan, plus 50% for the secured portion.
And loss assets.
Loss assets require a full 100% provision. Basically, they have to account for it as a complete loss on their books. These rules ensure their financial statements reflect the real risk.
What about how they're run? Governance rules.
Yes, very important. The RBI has rules on leadership and board structure. For instance, the CEO has an age limit max 70 years. Their term is capped at 5 years at a time with a total tenure limit of 15 years. The board structure is also mandated. The chairperson must be an independent director, and at least half of the entire board must also be independent directors.
So lots of independent oversight.
That's the aim. Plus, they must have mandatory committees, like an audit committee and a nomination and remuneration committee, to ensure proper checks and balances.
Any other key rules?
A few others worth noting. ARCs are strictly prohibited from accepting deposits from the public. They aren't banks in that sense. They absolutely must have robust internal audit systems and comprehensive risk management frameworks. Given the risky assets they handle, this is critical. And for transparency, they have to publicly disclose their track record on recovery and even name and shame non-cooperative borrowers. That adds pressure for borrowers to engage constructively. It's a pretty comprehensive regulatory net.
Okay, theory is one thing, but let's make this really concrete. Can we walk through a hypothetical but realistic example? Something that might help cement this for, say, RBI Grade B prep. How an ARC actually handles a specific stressed asset.
Sure, let's do that. A numerical example helps clarify the flow. Scenario setup. Let's imagine our bank is XYZ Bank. They have a problem loan on their books, granted to ABC Infrastructure Ltd.
Yeah.
The original outstanding loan amount was, let's say, 100 crore.
Okay, a significant size.
Definitely. And it's been an NPA for over 12 months, so XYZ Bank has classified it as a doubtful asset. Now, along comes Secure Assets ARC Ltd, looking to acquire this asset. Step 1. Due diligence and valuation. Secure Assets ARC dives deep. They look at ABC Infra's finances, the quality and market value of the collateral, maybe some land equipment, the legal status, the promoter's track record. After all this, they estimate the realistic recovery value isn't euro crore, but maybe closer to 30 crore. This forms the basis for their offer.
So a big haircut expected right from the start.
Often the case with doubtful assets. So Secure Assets ARC negotiates with XYZ Bank. Step 2. Asset purchase agreement. They agree on a purchase price. Secure Assets ARC will buy the 100 crore NPA for 25 crore.
25 crore for a 100 crore loan. Okay.
Yeah.
How do they pay?
This is key. It's typically not all cash upfront. The standard structure, often called the 15.85 structure, is used. Secure Assets ARC pays 15% in cash, which is 3.75 crore, 15% of 25 CR. The remaining 85%, which is 21.25 crore, is paid by issuing security receipts, SRs, back to XYZ Bank.
So the bank gets some cash now, but also holds SRs hoping for future recovery.
Exactly. The bank gets the NPA off its main books, gets some immediate cash, but retains a stake in the upside through the SR Step 3, funding an ARC's skin in the game. Secure Assets ARC might also issue some SRs to other qualified buyers, QBs, maybe a mutual fund specializing in distressed debt. But the key part is the ARC's own investment. Since XYZ Bank's investment in SRs is 21.25 crore, Secure Assets ARC must invest at least 15% of that amount. 15% of Euro's 21.25 crore is roughly 3.19 crore. So the ARC puts in over 3 crore of its own capital into these SRs.
Right, ensuring their interests are aligned.
Step 4. Valuation and NAV. A credit rating agency assigns a recovery rating. Based on the estimated 30 crore recovery, the initial NAV might be set at 0.30 per rupee of face value. 30 CR recovery, 100 CR face value. This NAV gets updated on June 30th and Dex 31st. Step 5. Resolution and recovery strategies. Now, Secure Assets ARC gets active. Let's say they implement a multi-pronged strategy over the next few years. Maybe they restructure the debt, giving ABC Infra a 3-year plan. They might take partial management control to push for asset sales. Let's assume they successfully managed to sell a non-core land parcel owned by ABC Infra for 15 crore. And through tough negotiations, they reach a settlement with the promoters for another 10 crore.
Okay, so 15 crore plus 10 crore.
That makes the total actual recovery 25 crore. Slightly less than their initial estimate of 30 crore, but still substantial. Step 6. Distribution of recovery. From this 25 crore recovered, the ERC first takes its management fee. Let's say it's 2% of the recovery, which is 2.5 crore.
Okay, 50 lakh.
Right. So the net amount available for distribution to all SR holders, XYZ Bank and the ERC itself in this case, is 24.5 crore. Remember, the total SRs issued were worth 21.25 crore, held by XYZ Bank, plus the ARC's 3.19 crore investment, totaling roughly 24.44 crore initially linked to the SRs. So distributing 24.5 crore means the SR holders basically got their principal back with a very small positive return in this scenario.
So not a huge profit, but the bad loan is resolved, the bank got cash up front, and the ARC covered its costs and investment.
Step 7. Redemption of SRs. The SRs are redeemed based on this 24.5 crore distribution. XYZ Bank records the outcome on its investment in SRs. The ARC also books its result. The process is complete.
That detailed walkthrough really clarifies the mechanics. It shows how they take a complex problem and break it down.
Exactly. It's a structured process designed to extract maximum possible value from a difficult situation.
Okay, so ARCs are one major piece of the puzzle, dealing with existing NPAs. But sometimes the problem isn't just one bad loan, it's the entire company that's in deep financial trouble, unable to pay multiple creditors. What happens then?
Now you're leading into the really big systemic reform. The Insolvency and Bankruptcy Code, the IBC, which came into effect in 2016. This wasn't just tweaking the old system, it was a fundamental overhaul, a game changer in how India deals with corporate and individual insolvency.
A game changer. Why was it seen as so revolutionary?
Well, it came about because the existing system was just broken. The IBC was based on recommendations from the Bankruptcy Law Reform Committee, BLRC, chaired by T.K. Vishwanathan. And its core objective is very clear and different from just debt recovery. It aims for a time-bound resolution of insolvency with the primary goal of maximizing the value of the assets of the distressed entity.
Maximizing value, not just collecting debt.
Precisely. And maximizing value might mean restructuring and reviving the company, or it might mean selling it off quickly before its value erodes further. Speed and value preservation are key. And importantly, its scope is broad. It covers companies, limited liability partnerships, LLPs, partnership firms, and even individuals. It's a unified code.
Unified. So what was it like before the IBC? Why was this unification so needed?
That's really the crux of why the IBC was such a landmark. Before 2016, India had this incredibly fragmented landscape for insolvency. You had bits and pieces in the Companies Act, you had SARFAESI for secured creditors, you had the Sikh Industrial Companies Act, SICA, you had debt recovery tribunals, multiple laws, multiple forums, often overlapping, sometimes conflicting.
Sounds like a recipe for confusion and delay.
Exactly. A creditor trying to recover money could get stuck bouncing between different authorities. Processes could drag on literally for years, sometimes decades. And during that time, the value of the company's assets would just wither away. Recovery rates were abysmal figures, like 25 cents on the dollar were often cited. It was bad for creditors, bad for the economy, and terrible for India's ease of doing business ranking.
So the IBC aimed to fix all that.
Yes. The goals were ambitious. Fast resolution, the target for corporate insolvency is 180 days, extendable maybe to 270, now capped at 300. Drastically reduce NPAs by forcing quicker decisions. Significantly improve recovery rates. And make India a more attractive place for investment by providing a predictable, efficient exit mechanism. And crucially, that dual purpose. The first priority is always to try and revive the company as a going concern. Find a buyer, restructure the debt, get it back on its feet. Liquidation, selling off assets piece by piece, is the fallback only if revival isn't feasible. That shift in philosophy is huge.
Okay, so it's a complex process. Who are the main players involved in making the IBC work? For someone studying this, say for RBI Grade B, knowing the institutions is probably important.
Absolutely. There's a whole ecosystem. At the very top, overseeing everything, is the regulator. The Insolvency and Bankruptcy Board of India, IBBI. They set the rules, regulate the professionals involved, and ensure the process runs smoothly.
Okay, IBDI is the boss. Who hears the cases?
Those are the adjudicating authorities. For companies and LLPs, the main body is the National Company Law Tribunal, NCLT. For individuals and partnership firms, it's the Debt Recovery Tribunal, DRT, which had an earlier role but now handles individual insolvency under IBC.
And if you disagree with the NCLT's decision?
You can appeal. The first level of appeal is the National Company Law Appellate Tribunal, NCLAT. And beyond NCLAT, the final appeal lies with the Supreme Court.
Right. And who are the people actually running the process on the ground?
Key figures here are the insolvency professionals, IPs. Initially, an interim resolution professional, IRP, is appointed, and then often confirmed or replaced by a resolution professional, RP. These IPs effectively take control of the company, manage its affairs during the process, and facilitate the resolution. They are regulated by insolvency professional agencies, IPAs. And one other crucial piece is the information utility, IU. Nesicel is the main example currently. Their job is to electronically store and verify financial information and debt records, providing a single source of truth to speed up claim verification. It's designed as an integrated system.
Integrated and, crucially, time-bound. You stress the speed aspect. Can we walk through the typical flow of a corporate insolvency case under IBC?
The CRP, right?
Yes, the Corporate Insolvency Resolution Process, or CRP. It's very structured. Let's map it out. Step 1. Default occurs. A company fails to pay a debt. Remember, under IBC, even a small default can trigger the process, though thresholds have been adjusted over time.
Okay, default happens. Then Step 2. Application to NCLT. Either a financial creditor, like a bank, an operational creditor like a supplier, or the corporate debtor itself files an application with the NCLT to initiate CRP. Step 3. NCLT admission rejection. The NCLT has a short window, ideally just 14 days, to review the application and decide whether to admit or reject it. If admitted, the clock starts ticking.
14 days, that's fast.
It's meant to be. Upon admission, step 4, moratorium begins. This is critical. All lawsuits against the company are immediately put on hold. No assets can be transferred. It creates a calm period. Simultaneously, the NCLT appoints an interim resolution professional, IRP.
The IP takes over.
Yes, the IRP takes control of the company's management. The board is suspended. The IRP then makes a step 5, public announcement, inviting all creditors to submit their claims with proof. Step 6, committee of creditors, committee formation. The IRP verifies all the claims received and forms the committee. Crucially, the committee consists only of financial creditors. They hold the voting power.
Only financial creditors. What about suppliers?
Operational creditors don't get voting rights in the COC, though their dues are considered. The COC, at its first meeting, usually confirms the IRP, or appoints a new RP. Step 7, resolution plan proposed. The RP prepares an information memo about the company and then invites potential resolution applicants, bidders, investors, sometimes existing promoters under certain conditions, to submit resolution plans, detailed proposals on how they'll revive the company and pay off debts.
Okay, plans come in, then the vote.
Step 8, COC votes on the plan. The RP presents the feasible plans to the COC. The COC deliberates and votes. For a plan to be approved, it needs a significant majority, 66% of the voting share of the financial creditors.
66%, that's a high bar.
It ensures strong consensus. Step 9, if approved. The RP submits the COC-approved plan to the NCLT for final validation. If the NCLT approves it, the plan becomes legally binding on everyone, the company, all creditors, employees, government, everyone.
And if no plan gets that 66% approval, or no plans are submitted?
Then the fallback is liquidation. The Conoco votes to liquidate, the NCLT orders it, and the company's assets are sold off systematically to pay creditors according to a defined priority. The whole process, ideally resolution, is meant to happen within that strict 180, 330-day timeframe.
That structured flow is key. Let's dig a bit deeper into some of those components you mentioned. Who exactly can kick this off?
Right, the initiation part. As I said, financial creditors, typically banks, MBFCs, bondholders, anyone who has lent money, operational creditors, suppliers of goods or services, employees owed wages they can also initiate, though there are specific thresholds they need to meet. And importantly, the corporate debtor itself can file for insolvency voluntarily, seeking protection and resolution, provided it gets shareholder approval.
And the moratorium period, you said it pauses everything. How long does that last?
The initial moratorium typically lasts for 180 days, from the date the NCLT admits the case. Its purpose is vital. Stop the chaos of individual recovery actions, prevent asset stripping, and give the RP breathing room to assess the situation and find a resolution. It can be extended by the NCLT by another 90 days, but that's usually the maximum for the resolution phase itself.
And the IRPRP, they essentially run the company during this time?
Yes, the interim resolution professional, IRP, appointed initially by NCLT, takes immediate control. Their first jobs are to manage the company's operations, protect its assets, collect and verify all creditor claims, and form the COC. The COC then either confirms the IRP or appoints a new resolution professional, RP, to carry the process forward, including inviting and evaluating resolution plans. They owe duties to all stakeholders but operate under the COC's supervision.
The Committee of Creditors, COC, seems all-powerful, just financial creditors making the big calls.
They hold the key decision-making power, yes, made up only of financial creditors based on their verified debt amounts. Their powers include approving or rejecting the RP, approving or rejecting any resolution plan, and deciding whether to push for liquidation. And yes, those key decisions like approving a plan or opting for liquidation require that 66% voting majority.
And the resolution plan itself, what if no one submits one or the COC just rejects everything? You mentioned liquidation.
Correct. The goal is always to get an approved resolution plan. This plan outlines how the company will be restructured, how debts will be handled, who will run it going forward. It needs COC approval, 66%, and then NCLT approval. But if no viable plan emerges or gets approved within the statutory timeline, 180 days, extendable to 270, overall cap 330, then the process defaults to liquidation.
And in liquidation, there's that strict payment order, the waterfall.
Exactly. If liquidation is ordered, a liquidator is appointed. They sell off all the company's assets. The money collected is then distributed in a strict sequence defined by the IBC, often called the waterfall mechanism. Broadly, the priorities are, first, the costs of the insolvency process itself, IRPRP fees, etc. Then come secured creditors, who choose to relinquish their security, and workmen's dues, up to 24 months. then employee wages, up to 12 months, then unsecured financial creditors. After that, government dues and remaining secured creditor dues. Finally, any leftover operational creditors, and last of all, if anything remains, the shareholders. This hierarchy is legally mandated.
Okay, let's try another practical example again, thinking about the level of detail useful for RBI Grade B prep. Let's track a company, say ABC Ltd, through the IBC process.
Good idea. Let's set the scene. Background. ABC Ltd is a manufacturing company. They took out a significant loan, say 50 crore, from a consortium of banks led by Bank X. Due to, let's say, a market downturn and some poor management decisions, ABC Ltd starts missing its loan payments. Step-by-step walkthrough. 1. Default occurs. ABC Ltd is unable to pay its installments for more than 90 days. Bank X, following the rules, classifies the loan as an NPA. 2. Initiation. Bank X, as the lead financial creditor, FC, sees little prospect of immediate recovery. They decide to take action under the IBC and file an application under Section 7 with the NCLT. The NCLT reviews the evidence of debt and default, finds it valid, and admits the application, let's say, within 10 days.
Okay, the clock starts ticking.
3. IRP appointment and moratorium. The NCLT immediately appoints Mr. Sharma as the interim resolution professional, IRP. Mrs. Sharma takes control of ABC Ltd's management, suspending the powers of the existing board. Simultaneously, the moratorium kicks in. All lawsuits against ABC Ltd are stayed. 4. Public announcement and claims. Mr. Sharma makes a public announcement about the start of CRP for ABC Ltd, inviting all creditors to submit their claims with proof by a certain date. Bank X submits its claim, as do various suppliers, operational creditors, and maybe some employees owed salaries. 5. COSI formation. Mr. Sharma verifies all the claims. Based on the verified claims of the financial creditors, Bank X and other consortium banks, she constitutes the Committee of Creditors, COSI. At its first meeting, the COSI discusses the situation and votes to confirm Ms. Sharma as the resolution professional for the rest of the process.
So the IRP becomes the RP.
Common practice if the COSI is satisfied. 6. Information memorandum. Mrs. Sharma, now RP, prepares a detailed information memorandum, IM, about ABC Ltd, its assets, liabilities, operations, potential. This IM is shared confidentially with potential resolution applicants who express interest. 7. Resolution plan submission. Several entities review the IM. Let's say a competitor, XYZ PVT Ltd, sees strategic value in acquiring ABC Ltd. They submit a formal resolution plan. Their plan proposes paying 30 crore upfront to be distributed among creditors, injecting fresh working capital, streamlining operations, and retaining 60% of the workforce.
So a concrete proposal for revival.
8. Evaluation and COSI voting. Mrs. Sharma examines the plan from XYZ PVT Ltd to ensure it complies with IBC rules. She then presents it to the COSI. The COSI members, Bank X and others, debate the merits. Is 30 crore reasonable? Is XYZ capable of turning the company around? After discussion, they hold a vote. Let's say banks representing 70% of the debt vote in favor.
That's over the 66% threshold.
Exactly. 9. NCLT approval. Since the COSI approved the plan, Ms. Sharma submits it to the NCLT. The NCLT reviews the plan, ensuring it's fair, feasible, and legally compliant. Finding no issues, the NCLT approves the plan. This NCLT approval makes XYZ's plan legally binding on all stakeholders of ABC Ltd outcome. Successful resolution. XYZ PET Ltd takes control of ABC Ltd. The 30 crore is distributed according to the plan. Bank X gets a significant portion of its dues, maybe 60 pays on the rupee. ABC Ltd continues operations under new management, jobs are saved, and the insolvency is resolved. And ideally, this all happened within, say, 250 days.
That's the success story. What if XYZ's plan wasn't good enough, or no one submitted a decent plan?
Alternate scenario. If resolution fails, if no plan was submitted, or if the Gokoshi rejected XYZ's plan, say it only got 50% votes, then Mr. Sharma would report this failure to the NCLT. The Gocho would likely then vote, again needing 66% majority, to recommend liquidation. Liquidation process. If liquidation is ordered, the NCLT appoints a liquidator, often the same RP, Mrs. Sharma. Her job now changes. Sell off all of ABC Ltd's assets, factory, machines, inventory, everything. The money raised is then distributed strictly following that waterfall mechanism we discussed earlier. Insolvency costs first, then secured creditors, workmen, employees, unsecured financials, government, etc. The company ceases to exist.
Okay. And those timelines, again, crucial for exam prep.
Yes, remember the key ones. Initial CRP period, 180 days, possible extension, plus 90 days.
Yep.
Absolute maximum deadline, including all litigation after the 2019 amendment, 330 days. Speed and certainty are paramount.
You mentioned amendments. The IBC hasn't stayed the same since 2016, has it? It's evolved.
Not at all. It's been actively refined based on experience and challenges encountered. Several important amendments have been made.
What were some key changes, say, in the 2018 Amendment Act?
The 2018 amendment brought some really significant changes, largely based on the Injeti Srinivas Committee report. One huge one was formally recognizing homebuyers as financial creditors.
Giving them power in the COSO.
Exactly. A major protection for individual buyers. It also expanded the definition of related party and strengthened Section 29A, which disqualifies certain people, like defaulting promoters or those connected to them, from bidding for the distressed company. This aimed to prevent backdoor re-entry by those responsible for the mess. To speed things up, voting thresholds were lowered. For major decisions like plan approval, it went from 75% down to 66%. For more routine decisions, down to 51%. This made it easier to get consensus.
Makes sense. Less chance of a small minority blocking things.
Right. It also carved out an exemption for MSME promoters, allowing them to bid for their own small or medium enterprises, recognizing their unique situation. It clarified no moratorium for personal guarantors, meaning lenders could still pursue guarantors even while the company was in CIRP. Lots of important tweaks.
Okay, and what about the 2019 Amendment Act? Any major shifts there?
Yes, 2019 was also very significant. The headline change was strengthening timelines. This is where the absolute maximum deadline of 330 days for completing the CRP, including all legal challenges, was introduced. Cases already pending beyond 330 days were given 90 days to wrap up. It was a strong push against delays.
Really hammering home the speed aspect.
Absolutely. It also introduced a minimum payout guarantee for operational creditors. They must now receive at least the amount they would have received in liquidation, or the amount proposed for them in the plan, whichever is higher. This addressed concerns about them being unfairly squeezed out. The scope of resolution plans was expanded, explicitly allowing for complex restructurings like mergers, demergers, or amalgamations as part of the plan. It also put pressure on the NCLT, requiring them to provide reasons if they couldn't determine a default within the initial 14 days. And importantly, it clarified that government dues, statutory dues, would also be subject to the approved resolution plan, providing certainty for bidders. It also gave the Kakongsi explicit power to vote for liquidation before a resolution plan is even considered if they felt revival was clearly impossible early on. These amendments continuously fine-tune the IBC to make it more effective and robust.
Okay, we've covered ARCs for buying bad loans and the IBC for comprehensive insolvency resolution. Let's go back to the beginning in a way, to that foundational law you mentioned. The Sarfazi Act, 2002. You called it an early interceptor. What's its core power?
Sarfazi, the Securitization and Reconstruction of Financial Assets and Enforcement of Security Interest Act. Quite a mouthful.
Yes.
Its core power, the real game changer it introduced, is enabling banks and notified financial institutions to enforce their security interest, basically, seize and sell the collateral pledged against a loan without having to go to court first.
So direct action.
Direct action, after following a specific procedure, of course. It cuts out potentially years of court delays for secured lenders trying to recover defaulted loans. It gives them significant leverage.
And what were the main goals behind bringing in Sarfazi?
The objectives were very clear and focused. Primarily, efficiency. Speed up the recovery of NPAs, which were clogging up the banking system. Second, empowerment. Give secured creditors real teeth, the power to act decisively without immediate judicial intervention. Third, market development. Enable the securitization of bad loans, bundling them up to be sold, and the reconstruction of assets, which links directly to the creation of ARCs. And ultimately, all this aimed to improve the financial health of banks and NBFCs by making NPA recovery faster and more effective.
So what are its defining features? Who can use it and when?
Okay, key features. It's primarily for secured creditors only, banks, and certain notified financial institutions that hold a specific charge or mortgage over an asset. They can initiate security enforcement only after the loan account is classified as an NPA, overdue 90 days, and after giving the borrower a 60-day notice. There are applicability thresholds. The outstanding debt must be more than 1 lakh, and the amount defaulted should represent more than 20% of the principal plus interest. So, not for very minor defaults.
And what can't it be used for?
Important exclusions. It specifically cannot be used for agricultural land. This is a major policy point. Also excluded are loans below 1 lakh and, of course, any unsecured loans, since there's no specific security interest to enforce. Remember, the RBI oversees ARCs, which are registered under and operate using Sarfazi powers. And while it bypasses initial court intervention, the borrower isn't left without recourse. They can appeal to the Debt Recovery Tribunal, DRT, against the lender's actions.
Got it. So secured loans above a certain threshold, non-agricultural, with an appeal mechanism.
And understanding a few key terms within SARFAESI is helpful. NPA is defined as per RBI norms, 90-plus days overdue. Secured asset is the specific property or asset pledged as collateral. And ARS is defined and enabled by SARFAESI itself. Securitization is the process of pooling loans and selling securities backed by them. And a security receipt, SR, is that instrument issued by ARCs, representing a share in the recovery pool, also defined under the Act.
Let's talk about the muscle of the Act, the actual provisions that give lenders power. Section 13 seems critical.
Section 13 is absolutely the heart of SARFAESI's enforcement powers. The process under Section 13 starts once a borrower defaults and the account is declared an NPA. The secured lender must then serve a 60-day demand notice to the borrower, detailing the outstanding amount and the secured assets.
60 days to pay up.
Essentially, yes. If the borrower fails to repay the dues within those 60 days, Section 13(4) kicks in, granting the lender powerful rights without needing a court order. The lender can take possession of the secured assets, take over the management of the borrower's business, if applicable, appoint a manager to manage the assets or business, and ultimately sell or lease the secured asset to recover the debt. This ability to take direct action is what makes it so potent.
But the borrower isn't powerless. There's an appeal.
Correct. Section 17, appeal to DRT. If the borrower feels aggrieved by the lender's actions under Section 13(4), maybe they dispute the default or the procedure wasn't followed correctly, they can file an appeal with the Debt Recovery Tribunal within 45 days of the action being taken. The DRT reviews the case. A further appeal against the DRT's order can go to the Debt Recovery Appellate Tribunal, DRAT.
So judicial review is still there, just later in the process?
Precisely. It ensures fairness while still allowing swift initial action by the lender. And just to complete the picture, Section 15 specifically deals with how IRCs can acquire financial assets from lenders through agreements, assignments, or by issuing those security receipts we discussed. It legally underpins the ARC model within the SARFAESI framework.
And you mentioned ARCs operate under SARFAESI. How does that work in practice?
Yes, RSCs are fundamentally creatures of SARFAESI. The Act gives them the legal standing to acquire NPAs and then use the very same enforcement powers available to banks under Section 13 to recover the dues. So RCs will typically pursue recovery through asset sale, restructuring the debt, or directly enforcing the security interest using SARFAESI provisions. Their registration itself is under Section 3 of SARFAESI, overseen by the RBI. And as we discussed, they need that substantial net-owned fund, currently heading towards 300 crore, to operate, ensuring they are financially sound participants in this process.
Has SARFAESI itself been updated over the years, like the IBC?
Yes, it has seen important amendments to improve its effectiveness. In 2016, a key change empowered district magistrates or collectors to actively assist banks in taking physical possession of secured assets, often within a target of 30 days. This addressed practical hurdles banks faced on the ground.
Made seizure easier in practice.
Exactly. Then, in 2021, we saw that specific amendment enhancing the minimum capital for ARCs to the greater 300 crore level phased. In 2022, the RBI set up that committee specifically to review the ARC framework functioning under SARFAESI, signaling ongoing evaluation. And in 2023, further changes were proposed focusing on things like better valuation norms, more emphasis on resolution plans by ARFs, and increased transparency. So yes, it's also an evolving framework.
But it's not a silver bullet, right? What are its main limitations?
No, definitely not a silver bullet. It has clear limitations. We mentioned the exclusions. Loans under UNLAC, completely unsecured loans, and crucially, agricultural land are outside its scope.
So significant chunks of lending aren't covered.
Correct. Its scope is limited only to secured creditors. Unsecured operational creditors, for example, get no direct benefit from SARFAESI. And while it aims for speed, challenges remain. Borrowers can, and often do, file appeals with the DRT under Section 17, which can lead to legal delays. While generally faster than traditional courts, the DRT process itself can sometimes get bogged down, slowing down the ultimate recovery. So it's powerful, but not instantaneous or universally applicable.
Okay, we've looked at RSCs, IBC, and SARFAESI in detail. Now let's bring it all together. How do these three frameworks, SARFAESI, IBC, and maybe we should include the DRT system they partly replaced or interact with, how do they actually fit together? How do they compare? This synthesis is probably vital for exam takers.
Absolutely. Understanding the distinct roles and the interplay is key. Let's do a direct comparison across a few critical parameters. First, the governing law, Sarfazi Act 2002, IBC, Insolvency and Bankruptcy Code 2016, DRT Recovery of Debts Due to Banks and Financial Institutions, RDDBFI Act 1993.
Different laws, different eras. Okay, who starts the process?
Initiated by Sarfazi. Only banks, financial institutions as secured creditors. IBC, much wider financial creditors, operational creditors, or the corporate debtor itself. DRT, primarily banks, financial institutions.
Okay, IBC is much broader on initiation. What's the core method of recovery?
Recovery method. Sarfazi focuses on asset seizure and enforcement of security interests, largely outside court. IBC aims for holistic resolution, revival first, or liquidation if revival fails, with the court-supervised NCLT process. DRT relies on judicial recovery through orders passed by the tribunal.
And the speed. Timeframes.
Timeframe. Sarfazi aims for relatively quick action, maybe around 6 months for enforcement after notice. IBC has strict statutory timelines, aiming for 180-330 days for the entire resolution process. DRT, historically often subject to significant delays.
And the court's role?
Role of court tribunal. Sarfazi, minimal initial court involvement. DRT mainly handles appeals after actions taken. IBC, NCLT is central throughout the process, admitting the case, overseeing the RP, approving the plan. DRT. The DRT is the judicial forum, directly involved in hearing the case and ordering recovery. So, putting it all together, Sarfazi is like a targeted tool for secured lenders. It gives them a fast track outside the main court system to grab the collateral when a loan goes bad. It's often the first line of attack for a bank with good security.
An early interceptor, like you said.
Exactly. The IBC, on the other hand, is the comprehensive umbrella legislation for insolvency. It deals with all creditors, secured and unsecured, and the debtor. Its prime focus is trying to save the business as a going concern, maximizing value for everyone involved within a strict time frame. Liquidation is the plan B.
And DRTs.
DRTs were the main forum for debt recovery before IBC and Sarfazi became fully effective. They still handle certain cases, especially individual insolvency under IBC and appeals under Sarfazi, but for major corporate issues, IBC is now the primary mechanism, and Sarfazi offers that powerful pre-IBC option for secured lenders. You can think of IBC as the main highway for resolving corporate distress, while Sarfazi is a potentially faster slip road available only to secured traffic holding the right ticket, security interest. Understanding these distinct lanes and when you can use them is crucial, especially for navigating questions you might face in an exam like RBI Grade B.
Right. That comparison really clarifies their different places in the system. We've covered a huge amount today, from the definition of NPAs through the specialized ARCs buying up bad debt, the comprehensive IBC aiming for resolution, and the enforcement power of Sarfazi. It feels like we've really mapped out India's strategy for tackling bad loans. And the key thing for you listening, I think, is realizing these aren't just theoretical concepts. They have real-world consequences impacting banks' lending capacity, deciding whether a struggling company survives or folds, affecting jobs, and ultimately shaping the health of the wider economy. Getting your head around them isn't just academic, it's about understanding the plumbing of modern finance in India.
Absolutely. And if we just step back and look at the bigger picture for a moment, these frameworks, Sarfazi, IBC, the role of ARCs, they aren't static. They operate in a dynamic world. Think about how global economic shocks like the financial crisis or the recent pandemic test these systems, or how new technologies might change lending and recovery. These frameworks have proven resilient so far, but they're constantly being watched, reviewed, and potentially adapted. Which leads to a final thought, perhaps. As the Indian economy continues to evolve, maybe facing new challenges like climate risk impacts on assets or disruptions from digital finance, how might the roles and the interplay between RRCs, IBC, and Sarfazi need to adapt further? What new pressures might emerge? How can they continue to ensure financial stability while also fostering sustainable growth? That's something worth keeping an eye on, thinking critically about how these vital mechanisms might evolve next. Keep digging deeper.